Good morning from our global headquarters in New York. I'm Danny Berger. Manish is off in the sun somewhere. Welcome to Bloomberg Brief. Let's set your agenda. Apple Intelligence, the iPhone maker, unveils its AI push. Elon Musk says he'll ban the OpenAI-equipped devices from his companies. The UN gets on board. The Security Council adopts a ceasefire plan for the Israel-Hamas war crafted by the U.S. And the Federal Reserve kicks off its two-day meeting. Investors await a rate decision along with the latest inflation data. So you got the pitch from Cook yesterday. Tomorrow, you get the pitch from Powell. What are bond markets doing in the meantime? You are seeing yields down by, let's call it 4 basis points. 4.42% is where you are on your 10-year yield. Calm after the sell-off yesterday in Europe, fueled by elections for the European Parliament and a snap election for France. Sorry, France, you get no respite in your bond market. Yields ticking higher by 6 basis points. The spread between Germany and France widening even further. So do you want to go in and buy European bonds now? Bill Gross certainly does. The S&P, that is down 0.2%. The type of volatility priced in for this market for Wednesday is quite remarkable. Citi's Stuart Kaiser talks about the biggest move being priced in for either direction since March 2023. JP Morgan says that we could see the biggest moves for the week, something like 1.4% off the back of, again, CPI and then Powell. Oh, and don't forget, you got a 10-year bond auction today and then a 30-year bond auction on Thursday. So plenty, perhaps, to be concerned about if you are a pessimist among us. Brent crude, that is steady after huge gains yesterday. At one point, nearly 3%. It was its biggest gain since March, perhaps a little bit of dip buying going on after some of the recent declines in Brent crude. So there's a lot for you to navigate. It's not just the economic data. It is not just Powell, but it is also the elections. We've had a taste of what the volatility could look like, and we're going to get a big election in the U.S. Idanna Appio, portfolio manager at First Eagle Investments, writes this, that U.S. elections are a ways off, but there's significant uncertainty around tariffs and fiscal policy. It will make rate setting more challenging for the Fed as we move into next year. And she joins us now. Idanna, thank you so much for joining us.
You.
Kind of bright, but definitely early this morning. I think this is so important because we're trying to wrap our heads around what happens at the end of this year with data that's maddeningly inconclusive. But 2025 is this huge unknown. So how do you even begin to position for something like that when we just don't know what it'll look like?
You know, I think we have to recognize, to your point, that there is a lot of uncertainty. And so we have to make sure we're investing for multiple states of the world. When you think about the upcoming election, depending on the outcome, it could have very different outcomes for tariffs. And then on fiscal policy, we know that the tax cuts are expiring at the end of 2025. So over the course of the year, there have to be, very difficult decisions made about extending those tax cuts or not, continuing with some of the big expenditure packages under Biden or not. And of course, the elections are going to make are going to make those outcomes, very different.
I mean, if you even look at, as I mentioned, the elections we've already had from Mexico to India, both of those saw big moves in the peso and Indian stocks respectively. We have European and now French elections that we have to deal with. It's a market that's been moving dramatically to results that were largely expected, maybe little differences here and there. What's that about? Is it just complacency?
So, I would, at First Eagle, we've been arguing for some time there's been complacency in markets when you look at valuations and equities or credit spreads or even term premium and sovereign bond markets. They're really not pricing these, very large political risk, obviously a lot of geopolitical risks as well. So I think you're seeing these reactions. If the outcomes of the elections aren't going exactly like markets are expecting, we're getting these reactions. And as you mentioned, upcoming elections, UK, France, then the US, plenty of room for volatility.
Well, I've heard the argument, look, obviously when it comes to Trump versus Biden, they are very different people and it is consequential who is elected. But in terms of policy, fiscal policy will continue to be loose. Protectionism is the trade, regardless of who's in the White House. So it doesn't actually make a difference for your portfolio who's elected. What's the argument against that?
I mean, I think it does make very important differences. Protectionism, maybe the degree, how much globalization is advancing or decoupling. That makes big differences for inflation, outcomes, which of course matter to the Federal Reserve and other major central banks. And on fiscal policy, we are going to have to make some very difficult decisions this coming year. And if if either, whoever wins decides not to make those decisions, then perhaps you see more of a reaction in the bond market.
Well, to that point, I mean, we have had this huge supply of duration come to market. Today, we're getting 10-year yields. On Thursday, we're getting 30-year. With that increased supply and a dearth of volatility, we still haven't seen any of these big events. Sure, we get a slight sell-off and the auction doesn't go as good as planned. Is that as bad as it gets?
I mean, I think we can just look back to last year when we saw the more extreme sell-off in rates. Yeah. Then you have the example of sort of the trust government when there's a real extreme reaction to negative fiscal developments. I don't think we should be complacent. We're still cautious on duration, despite sort of an economic outlook that might call for extending duration, given these very large fiscal risks that are overhanging. And as I said, term premium really not compensating you for lending to the government at longer level at higher.
Well, but I mean, again, this is something, to your point, given the uncertainty of 2025, doesn't feel like it's going away anytime soon. So what does that mean for a bond's place in a portfolio? Because usually this is the staid asset class. It's not going to move that much. It's low volatility, especially if you do any sort of volatility targeting. It's going to get a big weight in your portfolio. So has its place in a portfolio structurally changed?
That is a very good question. So I think it still has a role in the portfolio. We have been keeping duration short, as I think many might be, because the curve is inverted. Gives you a lot more optionality. Perhaps waiting for credit spreads, which have remained very tight. Waiting for credit spreads to widen in order to sort of reorient the portfolio.
Right. By the way, to the point of volatility induced by elections, the France-Germany 10-year spread, as we've been talking, has jumped to the highest since October. So you're really speaking to the right crowd now of the volatility in these bond markets. But it really has been a yo-yo narrative for markets. When we get CPI tomorrow and the Fed decision, is that going to solidify us either way? Or is it going to continue to be a back and forth and a choose your own adventure, interpret the data how you want?
I mean, I think the CPI report tomorrow is critical. If we get a print that's in line with April or slightly worse, as Waller sort of deemed like a C+ report, then I think it likely scuttles a September rate cut. However, if we get something a bit better, then I think it leaves September wide open. So I think we will have, and we'll have 2 more inflation prints before the September meeting. So I think the data will still be influential, but I think these, the data that's coming in will be influential for sort of the course of monetary policy for the rest of this year. But then, as we discussed, into next year, you have these big political events.
I mean, we can't forget the BOJ. It's easy to forget because Wednesday is so big. I know we have to get through that first before we can get to the BOJ. You've started to take down some of your yen hedges. What's your thinking there?
Look, I do think the Bank of Japan is closer. I think that we're starting to see in the data more influence of wage hikes, and that is feeding into service sector inflation. I think this gives the Bank of Japan room, perhaps at this coming meeting, to start to taper its balance sheets. I think we'll get some announcements there. And then probably in the next meeting or 2, maybe another rate hike, which, if you had asked me 6 months, a year ago, I would not have thought they would have been able to move as dramatically. So for us, the decision to remove the yen hedge reflects that we think these interest rate differentials that are very wide between the U.S. and Japan are going to start to narrow from here, slowly, but start to narrow. And the extreme undervaluation of the yen from a fundamentals perspective can then re-exert itself.
Right, and we know that this is a BOJ who pays attention to the yen. I mean, they somewhat have to, given the noise coming from the government. We've had folks come on this program and say, look, it can't be a one and done in terms of a hike. Because if that's what they signal, then weakness reignites itself for the yen. So is this a BOJ that needs to make clear that this is the start of a cycle?
I think the time has come now. I mean, recognizing, all central banks operating under tremendous uncertainty, none more so than the Bank of Japan, but it is time for them to lay out a framework. How are they thinking about exiting from extraordinary monetary accommodation, very large balance sheet, interest rates at still basically zero. So what is their path? What is the strategy? How are they going to evaluate data? They haven't laid out that framework, but I think the time has come. And that uncertainty, as you see, views are all over the place. I think that uncertainty is weighing on the end.
Right. Listen, no one will be happier about softer CPI and a dovish Powell than you, Ada. So,
Yes.
hopefully he has that to look forward to. Idanna, thank you so much for joining us this morning. Really appreciate you coming in early. That is Idanna Appio of First Eagle Investments. Okay, let's get you some of the other top stories that are trending on the terminal this morning. A Moelis employee is on leave as the bank investigates an incident. There's a video circulating online that shows a man identified as one of the firm's senior bankers appearing to punch a woman. The New York Police Department says no complaints have been filed on the incident. A New York City office building owned by a related affiliate is set to be sold at a steep discount. According to people familiar, Empire Capital and Namdar agreed to purchase the property at 321 West 44th Street for less than $50 million. That's a roughly 67% discount from what was originally paid in 2018. And Golden Goose, the luxury sneaker maker, and its shareholders are seeking to raise about 558 million euros in its IPO. That gives them a market valuation of about 1.9 billion euros at the high end. Bloomberg reported earlier that Golden Goose could be valued at about 3 billion euros, which Manis and I asked the CEO about, and he told us that he was happy with that valuation. Okay, coming up, Apple strikes an accord with OpenAI. Elon Musk doesn't like the sound of it at all. And later in the hour, we're going to catch up with Kennon, CEO of Clear Harbor Asset Management. Again, we're all gearing up for Wednesday, the fireworks show that is CPI and the Fed. This is Bloomberg. It's your Bloomberg Brief on this Tuesday morning. I'm Danny Berger in New York. Apple has unveiled its long-awaited suite of new AI features, and that includes a partnership with OpenAI, the maker of ChatGPT. Here's what Tim Cook had to say about getting generative AI into your Apple phones.
Recent developments in generative intelligence and large language models offer powerful capabilities that provide the opportunity to take the experience of using Apple products to new heights. Introducing Apple Intelligence, the new personal intelligence system that makes your most personal products even more useful and delightful.
Let's get more on this story with Bloomberg's Kriti Gupta, who joins us now. Kriti, great to see you. First of all, Dan Ives, he's an Apple bull, so maybe we expected this of Wedbush, calling it a historic day, that it changed the game. But did it do enough to boost sentiment? Did it really change the game when it came to how investors are approaching Apple and its outlook?
Well, if you look at the share price, the argument is absolutely not. In fact, one of the criticisms of Apple has been they're late to the game, and they have been for a very long time, putting their money in other things like a self-driving car, for example, or even ramping up their design cycle to the point that they're almost cannibalizing their own products. Those are the criticisms of Apple and kind of their development plan. AI has been kind of further back on their agenda. Now, compare that to the likes of Microsoft or Alphabet or even Oracle, for example. We're going to hear from them later today. You've started to see the AI push much more aggressive. Apple, even Amazon, has been accused of being further behind. So for that reason, there was a lot of anticipation ahead of this event that perhaps this would be the big game changer where Apple and Tim Cook and, of course, the C-suite there would prove investors wrong. And that didn't really seem to be the case when you look at the share price.
Well, when you talk about the catch-up argument, it goes something like this, that now Apple has to move really quickly, and they can't be as thoughtful as Apple usually is in terms of both design and safety. That brings in Elon Musk's threat. Because of safety, he says that he wants to ban Apple devices that are backed by OpenAI from any of his companies, that you're essentially going to have to put them in a lockbox if you try to enter, I guess, X or Tesla or SpaceX. What do we make of that threat?
Yeah, he didn't exactly explain the logistics of how you enter the office building if you've got a smartphone, given that most Americans do actually have smartphones. I think what's important to note here is that there is a history behind Elon Musk saying this. Remember, Elon Musk and Sam Altman kind of developed a lot of the early startings of artificial intelligence, even OpenAI together. They did have a falling out, and since then, both have actually been very critical about the dangers associated with OpenAI. So some of the criticisms of Elon Musk's criticism is also saying that perhaps he has a little bit of a personal vendetta there as well. On the other side of this, though, you can see where he starts to struggle simply because if you look at the way he's approaching Tesla or some of his other projects, he's very careful about introducing AI because there hasn't been that much regulation for it. Apple, on the other hand, is really only talking about bringing this in later in this year, perhaps going into 2025, and doing it via their Siri product. And remember, if you're like me, I'm a little old-fashioned. I actually have Siri disabled on my phone. So for that reason, it's actually the criticism of that criticism would be that perhaps it's not as big of a risk because you can turn it off if you don't want it.
You have Siri disabled, Critty.
I felt like I was relying a little too much on autocorrect and things like that. So, you know, to save the spelling, to keep the spelling intact.
Good for you, because I literally cannot spell for my life. Maybe I should do the same, but I'm literally like a grandpa with my phone. I'm like, Siri, what's the weather? I'm too lazy to swipe and open it. So I think one of the few people actually uses it. Hey, Critty, thank you so much for joining us this morning. That is Bloomberg's Critty Gupta. Let's get back to these markets, specifically the France-Germany spread. While the rest of the bond market calms down from the impact of the European parliamentary elections yesterday, alongside some hawkish speak from ECB members, unfortunately for France, the selling pain is not over. Yields are still moving higher in France. That means that the spread between Germany and France continues to blow out. We're now at the highest level since October. That is quite the jump up you can see there at the end. We're just speaking with Idanna Appio, a First Eagle, who says that this is a complacent market, hence some of the reaction that you are getting to these elections. Meanwhile, bond markets, again, elsewhere, they are calm while stocks are slightly lower. We're going to get a 10-year auction today, but the fireworks come tomorrow in the form of CPI and the Fed. Okay, coming up, geopolitics for you. The UN adopts a U.S.-crafted truce as Secretary of State Antony Blinken arrives in Israel. We'll have more on those ongoing ceasefire talks next here on Bloomberg Brief. It's your Bloomberg Brief. I'm Danny Berger in New York. Manus is out this week, no doubtedly on a sunny beach somewhere out there in the world. Let's get to your front page news now. A look at what's making headlines around the world. First up on the Bloomberg, the peso taking a hit. Mexico's President-elect Claudia Sheinbaum is going to be prioritizing several constitutional reforms. The reason the peso is selling off, weaker by about 1% this morning, is that there's concerns about major changes to the judiciary. And so far, since she was elected, peso weaker versus the dollar by about 8%. Next up, we have the Washington Post leading with this. Donald Trump was interviewed by a New York probation officer over video yesterday. He got special exemption to do that from Mar-a-Lago. The probation officer's sentencing report will help a judge decide how much time, if any, Trump will spend behind bars. I love this. According to a person familiar, the event was uneventful and lasted less than 30 minutes. And then, leading on the New York Times, the UN Security Council has adopted a U.S.-backed Gaza ceasefire plan. The vote comes as Secretary of State Antony Blinken visits the Middle East. Let's get more on this story now and bring in Jomana Bersecci, our Horizons Middle East and Africa anchor. So, Jomana, as I just mentioned, Blinken is visiting Israel. It is his 8th visit since the region, since October 7th. Where do we stand?
Yeah, that's right, Danny. His 8th visit since October the 7th. He is essentially in the region once more to shore up support for that Biden truce, the proposal that was put forward on May the 31st. Blinken was in Egypt yesterday meeting with President Sisi. He then moved on to Israel, had some meetings with the Prime Minister Netanyahu alongside the Defense Minister and even Benny Gantz, the minister who actually left the government over the weekend. And it seems as though things are moving in the right direction. A short while ago, Blinken was giving some commentary to reporters, and he said that he had received commitment from the Prime Minister that they would be happy to proceed with the discussions on that ceasefire proposal. And so far, the signals that are coming through from Hamas is that they're happy as well to proceed with indirect negotiations. Now, the sticking point right now, Danny, is that there are multiple phases in this peace plan. There's phase 1, phase 2, phase 3. Phase 1 would entail a 6-week ceasefire ceasefire and the exchange of some vulnerable hostages, including the elderly, children, and women, it seems like both Hamas and Israel are happy to sign on to phase one. The major issue becomes what happens with phase two and that proposal of a permanent ceasefire. And here, Hamas are saying that they're not going to sign on to a permanent ceasefire unless Israel provides some sort of guidance or commitments that they're going to stick to it. Israel are saying that they are not going to sign on to a permanent ceasefire unless they've secured the release of all hostages and completed their military objectives. So there's still some daylight between the two sides, but the fact that Blinken is here shows that some progress has been made.
And this also comes a day after Benny Gantz left the War Council, who had been perhaps a more moderate voice, and now Netanyahu has to rely on those more far-right voices in the War Council. What difference does this make as we start to talk about ceasefires, as we start to talk about what Gaza looks like post this war?
Well, we published a report, our BN colleagues published a report yesterday saying that even though Benny Gantz has left, ultimately the government will survive in its present format. Netanyahu's government still has a majority within the Knesset. And so it isn't going to lead to an imminent dissolution of the Netanyahu government, but it does tell you that he perhaps is more susceptible to some of the views of the more hawkish members of the government, including the likes of the National Security Minister Ben Gvir, who himself put his hand up and said that he wants to be a part of the war cabinet after Benny Gantz's departure. So certainly a lot of pressure from within the government not to sign up to the ceasefire proposal, but international pressure is building, and that's what we need to watch out for.
Jomana, really appreciate it. That is Bloomberg's Jomana Bercecci in Dubai. Coming up, we get back to the markets, the double whammy of a CPI and a Fed on Wednesday. We're going to catch up with Clear Harbor's Aaron Kennon next on Bloomberg. From our global headquarters in New York, I'm Danny Berger. It is a Tuesday morning ahead of a big CPI day. Let's set your agenda. Apple Intelligence, the iPhone maker, unveils its AI push, but Elon Musk says that he'll ban the OpenAI-equipped devices from his companies. The UN gets on board. The Security Council adopts a ceasefire plan for the Israel-Hamas war, crafted by the U.S. And the Federal Reserve kicks off its two-day meeting as investors await a decision along with the latest inflation data. It is a calm bond market this morning. Calm after the storm that were European parliamentary elections. Yesterday, a snap election called by France and more hawkish ECB speak. So we're down by about 3, let's call it 4 basis points. 4.42% is where you stand on your 10-year yield. French 10-year yields on the bottom of your screen. No respite for them. Still higher by 6 basis points. The spread between France and Germany is now at its widest level since October. Your S&P 500 futures, those are down by 0.2%. Analysts everywhere are saying that tomorrow will be an event of volatility, that options pricing are at the moment pricing in something like 1.25% move either direction for tomorrow, which would be the biggest move since March of 2023. That, according to Stuart Kaiser of Citi. We also have some bond auctions to get through. Today, we're going to get 10-year auctions, and then we're going to get 30-year auctions. Brent crude slightly weaker this morning, down by about 0.4%. Some big gains yesterday, nearly 3% off the back of who knows what, maybe some dip buying over a weaker overall oil price trend. So just 2 major central bank decisions. Keep in mind that we're going to get within 72 hours later this week. We got the Fed on Wednesday, the Bank of Japan on Friday. We already heard from the ECB yesterday. It has been a big month. Bloomberg MLive reporter Noor Al-Ali joins us now to look ahead. Noor, let's just first work through this U.S. calendar. We got auctions, we got data, we got a Fed decision. What kind of volatility is this going to bring us?
Quite a bit, right, Danny? Because, I mean, if you look at last week's hot jobs data, it's definitely thrown a wrench at the Fed's plans. I mean, reminder as well, we had for March the expectations from their dot plot of 3 cuts. Obviously, speakers since then have really paired those expectations for markets. Now there is some potential that we may get 2 expected Fed cuts by the end of this year. But of course, markets aren't even fully pricing that. They're only fully pricing one 25 basis point cut, potentially sometime in November, and the odds of a second one are still not there yet in terms of being fully priced yet. And to be fair, you know, we've had a dismal auctions sales just last month. You know, there wasn't as much demand for the 3-year yesterday as well. So overall, we are seeing a bit of a poor picture here. Yields trending higher. I know they are lower on the session today, but all points are leading towards higher yields towards the end of this week. Now we're just looking at that CPI print and where it's going to head and how comfortable the Fed is going to be with CPI still nowhere near its 2% target. We're looking at core, we're looking at services inflation, and we're also looking at wages as well. So a lot to factor in for the Fed, and so much up there up until the BOJ that's coming up on Friday. So quite a packed week here.
Well, we know no one would be happier about a soft CPI print and a dovish Powell than you, Ada, to help him along his journey to try to combat some weakness in the yen. Nor we've also heard from plenty of ECB speakers following their decision last week. Christine Lagarde, Madame Lagarde, said that we've made the appropriate decision, but it doesn't mean that interest rates are on a linear and declining path. Noggle talked about the Table Mountain metaphor being wrong. In this rate cutting cycle, is this different? Is this more of a mid-cycle tweak? And it's going to be some time before we see another cut from the ECB.
Yeah, look, I mean, Danny, if you look at the comments today from all the ECB speakers that we had Valeroy, we had Ren, and we had Simkis, all leaning more dovish, right? After the very hawkish cut that we had just last, they were leaning a little bit more hawkish after that hawkish cut that we had just last week. We had inflation projections being boosted for 2024 and 2025. Wages data also quite high, not comfortable within the levels that the ECB is pointing at. And we also have now a picture where the ECB is coming out and saying, well, look, we've just cut interest rates by 25 basis points, to the shock of many in the markets who look at the data and think, well, the data is not there yet. But that doesn't mean that the ECB is going to continuously now start cutting. There will be months, as Lagarde said, well, they'll hold rates. And so it's going to be quite interesting. Money markets are now expecting the ECB to deliver at least one more cut by December. We're potentially looking at November or September, but still a lot of that is up in the air. And potentially the Fed can start now coming in with those views that will maybe sway the ECB as well.
Nor, appreciate it. Bloomberg's Nor Ali setting us up for the week and the week that was. Joining us now is Aaron Kennon, CEO of Clear Harbor Asset Management. Aaron, I mean, the data has been somewhat maddeningly inconclusive as to how many cuts we're going to get later this year. We're going to get CPI tomorrow. For you and for your estimation of where this Fed goes, what's at stake?
Well, it's interesting. Tomorrow is an important data point for sure, Danny. But we're going to have 4 more CPI data points before September. And I mentioned September because prior to the employment data on Friday, there was like an 80% chance of a cut in September. And after the strong employment report, it's now only about 50% of the first cut coming in September. So the Fed's going to have a lot of CPI data to look at and a lot of wage data to look at. We've certainly seen softening on the consumer side. And frankly, before the jobs data on Friday, we were starting to see either through the JOLTS, the job openings data, as well as other economic indicators like the employment cost index, indicate some incremental softening on the labor side, which the Fed on the margin is still looking to see, particularly as it relates to wages.
I have this really interesting stat. This is from Bloomberg M Live Simon Flynn about what reactions are usually after a day where you have a Fed Powell conference. That usually 10-year yields have decreased 88% of the time after the Fed meetings in the past 2 years. 2-year yields dropped 76% of the time, and that is a trend that has persisted in 2022. Aaron, I can't help but wonder if that's simply because that this is a Powell with a dovish leaning. Every press conference he comes out, regardless of the data maybe, and has to fight the inclination to be more dovish. So just in pure, simple reaction to tomorrow's data, is it just going to be a race? If we have a strong data point come out, is that just undone by what we hear from Powell?
It's a great question. You know, we'll have to see. Clearly, we've made a lot of progress on the inflation front, Danny, and I think in some sense it's a human reaction that we sometimes hear during the Q&A from Powell. You know, we've come from 9.1% to 3% in CPI and PCE numbers under 3%, and we've made so much progress since mid-2022 on inflation that there's a level of perhaps just sort of humanness that we're seeing come out of the Fed, which is often a hopeful view that the last mile will not take as long as many fear. And we'll have to see on that front. Certainly the MOVE index, the volatility index within the bond market, is still elevated relative to history, but it's been coming off a bit on the margin. There's been a little more of a range-bound trading seen since the April peaks in the marketplace. So, certainly will be interesting to see the summary of economic projections as well, which is, essentially what does the aggregate FOMC believe as it pertains to the rate vector going forward.
Right. When it comes to this equity market, we had an earnings season that you got punished if you missed, but overall earnings weren't that bad. The big factor in equities falling was rates volatility. On this point, Aaron, HSBC writes this, that rates volatility is unlikely to spike to levels from last year, let alone from 2022. So we'd expect any weakness in risk assets to be both short-lived and shallow, and we think this presents a pretty good tactical re-entry point into risk assets. So, Aaron, just to kind of sum up, their view is the impact of rates on equities, it's going to be short-lived this time around. What do you make of that?
Yeah, I mean, I think they're sort of saying that maybe rates did peak in April, that the general trend line is downward, it may just take a little longer, and that lower rates should help particularly the equity market asset class and credit. And, I don't necessarily disagree with that view. I would just, look under the hood. If you look at the forward multiple of the S&P 500, for example, it's trading at 21 times forward, which is top decile expensive. But if you look under the hood at the remaining, call it 490 odd names, it's only trading at about 16 and a half times. And so, it's a very top heavy market right now. NVIDIA represents a third of the entire return of the S&P this year. The top 10 names represent about 72% of the entire 13 odd percent return this year for the S&P 500. But there are a lot of opportunities beneath that. And I think lower rates certainly would serve as a nice tailwind for risk assets going forward.
Aaron,
particularly also, I must caveat
Sure.
that with if we avoid a recession, if lower rates are a function of benign inflation data rather than really weak economic data.
Aaron, I was going to say, I feel like this should be a caveat over everything we talk about. If there's a recession, it will change a lot. Aaron, I'm afraid that's all we have time for. Thanks so much for joining us. Aaron Kennon of Clear Harbor Asset Management. Okay, quick look at your Treasury market this morning. It is more calm compared to yesterday. Your 2-year yield down 4 basis points. For most of the curve, that's what it looks like, 3 basis points on the long end. We get a 10-year auction this morning. French yields, though, still ticking up higher. And on the point of European debt, Bloomberg's Alex Steele caught up with PIMCO co-founder Bill Gross on his outlook for the 10-year note both in the U.S. and Europe.
I don't think there's much of a trade on treasuries. To my way of thinking, the 10-year, which is close to 4.5%, let's call it 4.5%, is dependent upon inflation, which we'll see on Wednesday, and we'll know more because of that. But if inflation is 2%, I think the 10-year belongs close to 4%. If it's 3%, it belongs closer to 5%, and we're right in the middle. So at the moment, with 4.5% 10-year treasuries and break-evens at around 220, that's a 470 basically break-even for the nominal 10-year treasury, and I think we're about there. There's not much to be done until we know more.
Bill, what are the chances that we see, say, the median dot in 2024 and 2025 actually move higher? I mean, do you think there's a possibility, and what would be the reaction to something like that?
Well, I think it would be negative. The Fed has basically signaled they're sort of done, perhaps 95% done in terms of raising rates. It's not that they can't raise them if the print on CPI isn't bad for the next several months. But, I think the market basically anticipates the Fed to stay, and maybe in September, maybe in December, maybe 1 or 2 cuts if, the current numbers continue as we've seen them.
That is Bill Gross. By the way, he went on to add, because he clearly doesn't see much range for this bond market, that Europe is the land of bond opportunity, given that yields have moved higher in Germany, and there's opportunity there with the divergence between the U.S. and European cycle. But the bond king, for what it's worth, is more of the stamp king now. He's got an auction coming up of his stamps on Friday of $20 million. Okay, coming up, it's Apple striking an accord with OpenAI. Elon Musk says that he would ban their devices on safety concerns. We're going to catch up with Matt Bloxham of Bloomberg Intelligence on that next. It's your Bloomberg Brief. I'm Danny Berger in New York. Manis is off today, dreaming of his new AI-powered iPhone, I'm sure somewhere out there in the world. On that, shares of Apple, they are lower in the pre-market, less than 1%. But investors have shrugged off the tech giant's AI announcements, maybe because they were largely expected. There, Apple unveiled a suite of new features, including a partnership with OpenAI, the maker of ChatGPT. Here's CEO Tim Cook on getting generative AI into Apple devices.
Recent developments in generative intelligence and large language models offer powerful capabilities that provide the opportunity to take the experience of using Apple products to new heights. Introducing Apple Intelligence, the new personal intelligence system that makes your most personal products even more useful and delightful.
Shortly after that, Elon Musk tweeted that he would ban Apple products, or posted on X, whatever the language is now, that he would ban Apple products which integrate Sam Altman's software at the OS level. Let's get all of this with Matt Bloxham from Bloomberg Intelligence. Apple Intelligence. I mean, they're coming for your job here, Matt. Bloomberg Intelligence, Apple Intelligence. Yeah. But how much do we glean of what Apple Intelligence is really Apple versus just an open AI offering?
No, I mean, I think this is very much Apple at the core. You know, I think the ChatGPT OpenAI part didn't really get a huge amount of airtime yesterday. I think that was intentional, because really what Apple is selling here is largely an on-device AI platform with a carefully managed kind of cloud layer around the outside when it's needed. And that's quite a big differentiation to the kind of the rest of the generative AI platforms we've seen out there. So I think, yeah, they want to give everybody the best of both worlds, if you like, but even the implementation of ChatGPT has some guardrails around it to protect people's privacy. So, you know, I think very much from Tim Cook's perspective, this is an Apple development that's essentially at the core of what they're offering here.
I want to get to the OpenAI and privacy question in just a moment, Matt, but usually Apple is not necessarily the pioneer of new technology, but it's the company that comes in and makes it sleeker and better. The iPod is a great example of this. The idea that MP3 players were already out there, but then Apple comes in and introduces the iPod and has this really sleek version that gets people excited. So AI, it's not necessarily the pioneer, but did we get a sleeker, better version of its integration?
Yeah, absolutely. I mean, you know, if you look at all of the different features that Apple have announced as part of the platform, they're very familiar. You know, it's things like summarization, automated kind of, you know, suggestions of how to reply to an email, ability to kind of edit photos more intelligently. So they're all things we've seen from standalone businesses. And as you say, Apple's been quietly working its own versions of those in the background and is waiting to release them until they think that they're ready and they're going to give users a really kind of high-class experience. So that's what we're seeing. So, you know, it's going to be a kind of an evolution of the operating environment that everybody's familiar with if you're an Apple user, and it's going to elevate all of those core applications, messaging, email, Safari, Siri, photos, all these applications that people use on a daily basis are going to make them better, enhance them in a gradual way, really.
Maybe it is finally time then for me to upgrade from my iPhone 12. Just quickly, Matt, on the security risk with OpenAI, you say that they introduced guardrails. Elon Musk says it's dangerous. You can't bring it in an OpenAI OS device into any of his companies. Which is it?
Yeah. I mean, it's a good question. We'll have to see the real detail of actually how the kind of technology is working in the background. But, you know, if you look at what Apple's saying, they're saying that IP addresses of the user will be masked and that ChatGPT won't be holding on to the searches or the queries you make of it. So that's quite different to how ChatGPT works if you're a kind of standalone subscriber to their system. So they have been thoughtful about it. I mean, obviously, Elon Musk has some legitimate concerns about the future of generative AI, but whether there's anything really to worry about in terms of how Apple are implementing it, I think we'll have to wait for the kind of real software experts to kind of unpick that.
And we do know Elon Musk can hold a grudge. He doesn't get ad dollars on X from Apple anymore, and he has his own AI startup. Matt, we're going to have to leave it there. Matt Bloxham from Bloomberg Intelligence, not Apple Intelligence, Bloomberg Intelligence. Thank you very much. Let's stay with tech. Oracle is going to report fourth quarter earnings after the market closed. Let's bring back Bloomberg's Kriti Gupta on this. Kriti, what are we expecting?
Well, we're expecting them to impress, and the bar is actually high. When you look at some of the numbers here, I'm going to look down for a second. Analysts projecting sales are going to increase by about 5% to about $15 billion in the last 3 quarters. Now, this is a really big deal because we know when it comes to AI, when it comes to cloud, Oracle's competing with some of the biggest players in the business, Microsoft, Alphabet, AWS as well. Oracle's kind of seen as this old guard tech company, the likes of Dell, HP, for example, the ones that were really booming in the 90s and then kind of lulling a little bit. It was actually, however, in kind of the forefront of cloud and the transition to cloud. Now they have to really prove that they have what it takes to really compete with the big boys on AI, and that's the bar they have to meet in their earnings report today.
We've seen other earnings in this sector, in cloud, in software, get absolutely pummeled if they don't have an AI offering that is monetizing itself. Given what we've already heard from Kriti, how likely is it that Oracle can show up and outperform, as you say, the big boys?
Yeah, well, Oracle is making some pretty decent kind of moves in terms of gaining market share. Remember, it's competing with Alphabet's competing with AWS and Microsoft as well. Now, Microsoft and AWS, so Azure and AWS, I should say, are going to be your dominant players in cloud. Oracle is directly mostly competing with Alphabet. The problem that Oracle has is it's got a little bit of an overhang on it when it comes to its Cerner business. This is a company that they acquired back in June of 2022 that would really has everything to do with health records. The idea here simply being they were going to bring this kind of old-fashioned healthcare record system into the 21st century and do it via cloud. The problem is that infrastructure is taking far longer to implement. So that growth prospect that analysts are talking about, they're hoping that this is the last quarter where there's going to be that overhang, and then from here on out, it's much bigger jumps. But again, Danny, the bar is high for this company.
Kriti, appreciate it. Bloomberg's Kriti Gupta there on Oracle earnings. Again, we get them after the bell today. Coming up, we're going to hear more from the ECB. Plus, it's a Treasury bond auction today. A lot to look forward to before your CPI Fed Mega Day here on Bloomberg. It's your Bloomberg Brief. Danny Berger in New York here. Let's get a look at what is ahead for the day for you. We're going to get more remarks from ECB members on deck. That will include Holtzman, Villeroy, and Lane. We heard from quite a few yesterday, including Madame Lagarde, who said they're not on a linear path. Then $39 billion of 10-year bond auctions. That's at 1 p.m. Eastern. Plus, there's just speaking with Kriti Gupta about we're going to have Oracle earnings after the market close. Let's get some individual stock movers for you, too. Eli Lilly, that is extending its rally up nearly 3%. The FDA advisory panel unanimously voted that Lilly's Alzheimer's drugs have benefits that outweigh its risk. The final decision is expected by the end of the year. Cleveland Cliffs, that is dropping. JP Morgan has downgraded the steel producer to neutral. They've cut the price target from $23 to $17. Bill Peterson, the analyst there, says that forward pricing is likely to be weaker than previously expected. Let's get back to these European bond markets. Unfortunately for France, the rest of the bond market has been calm, while France is still selling off. The spread at the moment is at the widest since October. It's not going anywhere. By the way, a headline just out that a French person close to Macron has denied a report about his resignation. There had been some perhaps rumors he'd resign if he lost the French assembly election, that according to the Times. So French bonds continue to sell off. That's it for the brief. Surveillance is ahead.